Hello everyone. Today I'll be presenting the analysis of bond price and interest rate. Let's first look at the two bonds, A and B. Although both have the same credit rate, coupon rate, or par value, bond B will trade at a higher price than bond A. The reason is simple. Bond B has a shorter maturity period, which means less risk. Investors prefer bonds with shorter maturities because the chance of market changes or unforeseen events affecting them is smaller. This lower risk makes bond B more attractive, so it's higher price. Consider what happens if interest rate increase. When the interest rate rise, bond prices fall because the fixed coupon payment become less attractive compared to new bonds issued at higher rates. In this case, bond A with its longer maturity period will experience a larger price decrease. On the other hand, bond B with its shorter maturity will see a smaller decrease in price. Essentially, the longer the maturity, the more sensitive the bond is to changes in interest rates. Building on the previous point, bond A will have a higher percentage price change when interest rate rise. This is due to its longer duration, making it more sensitive to changes in interest rates. The longer the bond's duration, the greater the longer the bond's duration, the greater the impact of rising interest rates on its price. In contrast, bond B with its shorter duration will have a smaller percentage change in price. So here's a numerical example. Assuming the market interest rates increases from 5% to 6% for bond A, which has 30 years to maturity, the price might drop significantly to $820. However, bond B with only 5 years to maturity will see a smaller drop, with its price potentially falling to $950. This example highlights how long-term bonds are more affected by changes in interest rate. Lastly, let's discuss an investment strategy. If people expect an economic slowdown, it's wise to consider investing in long-term bonds because in a slowing economy, interest rates are likely to fall as central banks try to stimulate growth. When interest rate falls, long-term bonds experience greater price appreciation, offering investors a chance to benefit from capital gains. Therefore, during an economic downturn, long-term bonds present a better investment opportunity to their potential for higher returns as rates decline. These are the references. Thank you very much.